the inventory that's on the market right now, at least from our firm, is priced in a way that the seller is motivated.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, we got Heidi with Michel Commercial again. Heidi, how are you doing today?
Doing well. Thanks, Todd, for having me. Always a
Yeah,
pleasure.
absolutely. So we're going to talk today about just market updates and what's going on. And actually, I think it was yesterday you made a post about the recent activity in specifically in the Twin Cities, but recent activity probably, I don't know if it's across the market or just the Twin Cities in whole, but what are you seeing out there in the market right now?
Yeah, great question. So, yeah, my post was definitely real-time market shift. So, this is also very particular to suburban properties, well-located
Mm,
suburban, well-maintained properties. So, two recent deals we had, the one that I made the post about specifically was about a deal we have in Blaine, which is a great suburb, growing suburb, and a deal we have in Champlin, which is a very supply-constrained, desirable suburb. And the shift has been, we think we've seen pricing bottom out. And reason being is because the Fed has indicated interest rates are going to be cut. Based on our quarterly review, the 10-year was 4.45 on average last quarter, Q2. Well, today the 10-year is 3.795. So
big shift.
that's a huge shift right there. And the Fed's indicated possibly 25 basis points, hopefully 50 or more. We'll see. But buyers are we're seeing more aggressive buyers right now and more buyers, frankly. We've seen REITs out of the picture for a while. We've now seen Midwestern REITs enter back into our market, not California, not Boston yet. Yes, in some ways, but a bigger shift of our offers are from Midwestern REITs, North Dakota, locally, Wisconsin, Iowa, Midwestern REITs entering back for those Class A properties. So going back to that Blaine property, really desirable offering, really desirable location, 12 tours. We had a 75% tour to bid ratio. So
What's been typical prior to that, like over the last couple of years?
So desirable asset, you're probably looking like 50%.
Oh, wow. So 75 is a big shift.
Huge. And that's a desirable asset. So I've recently sold other properties in other suburbs or other areas like St. Paul, Minneapolis, and you might be 30%. It's much lower.
Yeah. Yeah.
And in other in tertiary markets, you could have two offers, just things like that. So 75% and 9 offers, that's a lot of offers. And they were really competitive. And the top 3 offers all were clearly set apart from the other offers. And it was clear to us when we're looking at the 9 offers, 6 of them were all clustered, 3 of them were also clustered. And the 3 that were clustered were pretty much clustered around the same price, which tells us they're really focused on very similar metrics, just like the other 6 offers that were clustered. When I say clustered, I mean they were very similar. They were almost the same pricing. So you had 2 separate groups. 6 were in one group, 3 were in the other group. Top 3 are now in best and final. And we're expecting to exceed our pricing expectation in that regard. We have not exceeded pricing expectations since 2022. And the reason for that was when interest rates skyrocketed, brokers, sellers, not as much buyers, but we were trying to catch a falling knife in the way of we were trying to figure out where is the new pricing. And Todd, you and other buyers were trying to tell brokers and sellers, we want bottom pricing.
Yep.
And brokers and sellers were saying, we don't want to do bottom pricing.
Yeah. Wait a second. No, time out.
Yeah.
We're not ready for that yet. Yeah.
And I think we've hit the bottom and we're coming back up. Now, that's very particular to quality suburban assets.
Yeah.
We've got deals right now in some urban areas. And this is also very Twin Cities focused. I'm a Twin Cities multifamily expert, but I do know this market. I'm not an expert in all markets. And, but so Twin Cities focused, that suburban quality asset, we've had the highest absorption rate in those. We've also had so higher demand, and then we've had zero rent declines in our market as a in aggregate, whereas other markets that had immense rent growth are now dropping off with immense rent declines, double digits in both. They had double digits in both directions. We never saw actual rent declines across our market.
Right.
There are particular markets, Uptown has seen a rent decline, but that's a very niche neighborhood of our Minneapolis CBD central
Yeah.
business district.
Yeah.
So,
And that's in direct correlation of what happened in the Uptown area during the George Floyd, riots and all that kind of stuff. So, and
exactly.
what's transpired since then. So yeah, that's more of a very small market segment of the entire Twin Cities. But yeah, that's been interesting to me is that the Midwest has held up really well, and which actually, quite frankly, not too surprising. But the Midwest has held up really well. In the Twin Cities, however, I was a little, and I think a lot of people were sitting here waiting to see what would happen because we had a lot of inventory that hit the market and a lot of inventory. But as far as what I've seen, and correct me if I'm wrong, that inventory has really largely been eaten up by renters pretty quickly.
Yep, absorbed really quickly. And our vacancy rate, once again, this is across the whole Twin Cities, seven county metro. But vacancy rate last quarter, it's gonna be wrong, but I think it was like 8.2%, which is high. That's not a typical vacancy rate that the Twin Cities sees. We're typically around 3%. That's directly correlated to influx of development that we haven't seen in years.
Yep.
And now it's already dropped to, what was the vacancy rate? I'm looking at my notes here. I think 7.4%. And when I just looked it up 2 days ago, it was 7.2. This was a report from Q2. So we're dropping a vacancy rate 100 basis points in the matter of 3 months across our market. That's a lot. And that does go to show your absorption. Once again, suburban assets getting absorbed in a greater way than urban core assets. But once again, I am a believer in our urban core. Yes, Minneapolis, St. Paul has had its struggles, continuing to work through those struggles. But those are our urban cores. That's the only one we got.
Yep.
So I know that I've talked about it on social media, and other people have talked about it too, that Widener out of Washington has taken a big bet on the Twin Cities, and good for them because they're long-term holders and it's going to work for them. They bought trophy assets well under replacement costs, well under pricing that we're selling they bought luxury, ultra luxury for suburban moderate class A pricing.
Yeah. And they in the urban core, right? It didn't they were the high rise buyers?
Yep. Yeah, they just bought there's been one other buyer of Minneapolis high rises in the last 16 months, other than Widener. Widener has bought everything.
Wow. The type of buyers that you're seeing, you mentioned the one offer, the Blaine offering, but you guys have been listing a lot of different properties, and you're seeing multiple different types of buyers. What are the types of buyers that you're seeing in the market, and who's typically, winning these deals?
Good question. So I'll talk about Blaine a little bit, but then I'll move to another product type. So Blaine is 152 units Class A. We're seeing high net worth family offices, local ones that want to hold for a long time. We're seeing a lot of turnover of these family offices selling older products, moving into newer products. And it's a changing of the guard within their personnel as well. The long-term family operators of the business are aging out in the way that they want to retire. They don't want to be tied to this business anymore, but they're wanting to leave something in a really good position for the next generation or whoever is running that family office. It doesn't have to be a family member.
Yeah.
And so what we're seeing, we've done lots of those family office. That's one of our kind of niches, is we really work with local private owners that own $500 million in this market, and they want to move older properties into brand new properties, and they're going to hold them for 30 years. So their metrics look a little bit different than like
A
you,
lot
Todd.
different.
Yeah, a lot of different. And they've got tons of capital. So one of the family offices that we work really, really close with, they like to buy things cash. And they aren't operating in cash right now, but they're operating at 50% LTV, which is in a lot of ways a lot of cash. And so if you're talking about a $30-40 million deal, well, they've got $20 million ready to go just to deploy. And they actually have in excess of 20 million ready to deploy. So they are major players right now. I'm talking about my Blaine deal, but in Blaine, just next door, a family office purchased another Class A property. And this is a great time for family offices because as REITs, Eastern, Western national REITs have turned their face away from the Twin Cities, this is a great time a family office can capture properties below replacement costs in great locations, and they get to win the bid. And the bid is a better investment. The fundamentals are better for them because there's just some of that less aggressive competition, but it is fierce. The competition is still fierce.
Yeah.
We're also seeing,
But
so
they're
for
not meeting the return expectations that like a group like mine is needing. They've got a lot of cash. They're not, and if you the more cash you have, the interest rates mean less, right? So the higher the interest rates, if you're buying out cash, interest rates don't matter at all. If you're buying with 50%, they don't matter as much. And then if you're going to hold it long term for 30 years, you're not worried about I mean, you still need a cash flow, right? But you're not worried about the cash on cash return today and the IRR and that stuff's meaningless.
Right. So then juxtaposition, we are selling a value add. It's a distressed property. This is the Champlin deal, 135 units. Once again, family ownership, long-term family ownership.
Mm-hmm.
Todd, your team was interested in that one.
Mm-hmm.
And
Very, very much.
yes, and that buyer type is way different. So you've got a little bit of shinier product. You're looking at family offices looking to upgrade their product. You're also looking at local REITs, local meaning like Midwestern. You're also looking at larger syndication groups like yours as well. And then when you're looking at a value add, you're looking at a way different buyer pool, a little bit grittier buyer pool that is really wanting to turn a profit more quickly. Class A properties, they kind of run well, but with little incremental returns, where a value add property, you can increase your rents by $400 in some cases. This property that we just have under contract, the buyer is going to do a full remodel and easily they can get $400 more per unit. And it was a very vacant property just because management didn't actively fill it up because they just owned it for a long time and they just kind of forgot about it. And so perfect storm for a syndicator or another group that really recognizes the area has tons of potential. And this is the worst property in the whole area. And it's the only vacancy in the whole area. And so there was a lot of competition there. We had 21 tours, 14 offers.
Wow.
So do the math there. That's once again over 50%. I'd have to do the math on what 14 divided by 21 is, but
yeah. 65%, 62%. Yeah.
Mm-hmm. And we had a 10% price increase in best and final. That's a big price increase. We also haven't seen that type of price increase since 2022. And 2022 really was the end of the peak, and peak pricing hit, and then we just totally dropped off. So once again, if you're looking at this like a graph, we definitely peaked 2021, 2022, we just dropped off, and now we're climbing back up. So as a buyer, it's really important to really know what's happening because you don't want to buy at the peak. It happens. You never know where the peak is until the peak is passed. But you want to buy when pricing is still low because the last time we were in a business cycle, it was like a 15-year business cycle. Well, how long are we going to live at pricing being depressed still if we know we're on the way up?
Yep. Okay. So what else are you seeing in the market? We're seeing a lot of properties come up.
Mhm.
Is that something you're getting? Is your group getting a lot more calls from potential sellers, from BOVs, BOV requests, and serious sellers? It felt like for a long time there wasn't a lot of serious sellers. Maybe I'm just wrong, but it just felt like even the properties that we would look at, like it, a lot of sellers were just fishing to see if they could get what they needed, but they weren't that serious. Are you seeing a lot more serious sellers and a lot more properties that'll, and we have a lot of inventory right now for sale, but are you seeing that continue? Is that a trend that's going to continue, or is that just temporary?
Good question. I hope it continues. And here's another change too. So when brokers were part of the problem here. I'm just going to say it. We were part of the problem. We were trying to catch a falling knife, and the falling knife was pricing. And so we were working with what we thought were serious sellers, and we were bringing properties out at what we thought were okay prices. We knew they were inflated. We get it. And we were trying to catch a falling knife. Pricing fell way faster than anyone ever anticipated, 20 to 30% in the Twin Cities
Yeah.
within a span of less than 6 months. I mean, that's huge. That's unheard
Yeah.
of. And so we were part of the problem. Brokers, like myself included, bringing properties to market that were not priced correctly because we didn't know where pricing was. No comps were able to support lowered pricing. Buyers, we were finding out in real time what buyers were saying. And so there's been an adjustment. I can just speak for our team. We are pricing properties. We always price properties optimistically. Our goal is to get sellers the highest price. That just is the way it is.
Yeah.
And but also within reason. Sellers know what's most likely. We always let them know. If they are willing to sell at that, we're willing to bring it to market. If they're not, we're saying, let's wait, let's revalue. The Fed has indicated there may be some price cuts. The true growth value creation is NOI increasing.
Right.
So here are ways, Mr. Seller, that you can increase your NOI, raise your rents, implement a resident billing utility billing system, RUBS. Those are really the main avenues. Increase those two, and that's how we can get value creation. If you're going to really focus on interest rate reduction, you're going to get just maybe a teeny value creation based on whatever the market bears. So to go back to kind of your idea of we've got a lot of inventory, the inventory that's on the market right now, at least from our firm, is priced in a way that the seller is motivated because we listed a bunch of properties that didn't sell. And that was just the way that the world was going at that time.
Yeah.
Brokers now are seeing where pricing is, and we're bringing pricing to properties to market with motivated sellers who know what is going on. And when we value properties now, we're saying this is what the market is bearing. Possibly in the future, you could get a little more if interest rates are lowered. So let's reevaluate in 3, 6, 10, 12 months. And let's keep gauging this because if your pricing, for example, another property we listed, seller said, I need this pricing. We just said that pricing is not possible in this market. And then that seller decided, okay, he wants to sell anyway. So we did sell, and it is under contract at the pricing that we said, was optimistic, but not exactly his desire, but he's motivated. So,
Yeah. Yeah. Well, that's good.
so all that to say, Todd, properties that are on the market now, the major brokers, there's been also a flood of newer brokers, unfortunately, that this is just a tough time. If you didn't have a strong reputation, you really have not been experiencing all of the flood of deals. So the brokers that are bringing deals to market are the ones that have staying power, the ones that are smart, data driven, very focused. So I would definitely go for the properties that are in the market right now, because likely is those brokers, just like myself, we don't want to waste our time. We're not taking overpriced listings anymore. And so those deals that are being brought to market are going to sell, and it could be to you.
Yeah. Yeah. And that's a good point. you can chase all kinds of deals because there's a lot of people out there throwing deals out there. But if you've got a reputable broker that you're working with, they're they're likely pricing the property correctly. I would say the only, you know, the times where I see the most properties that don't actually trade. I mean, there was obviously a time there from 2022 to through 2023 where a lot of properties just didn't trade. But prior to that, the properties that I typically didn't, I saw that didn't trade were a lot of the, off market properties, where, you might have a seller that's saying, hey, if I can get 20 million, I'll sell it. And so the broker's like, yeah, I'll shop that around a little bit. And, it's maybe only worth 16 million. So that it never sells. Right. But, um, if I'm expecting that if you've got experience and you're putting a full OM out there, I know Michel Commercial, if you guys are going to put a full offering memorandum out there and put it on the market, it's going to sell. Like it better sell because, because you don't want to spend the time and the effort and the money, just to have a cute offering out there and never sell.
Exactly. Yeah. Todd, a little bit more about investment fundamentals that, a reason why we've got tons of people looking to our market for the first time. So we've had more people continue to buy properties and not Class A, large economy of scale properties, but like 100 units. We've
Yeah.
got groups from Ohio, Wisconsin, North Dakota, Utah coming in and buying 70 units, 100 units. That's a
Mm,
small bite for these groups to come in. They've got to find management, they've got to
yeah.
find personnel. So there's a lot that goes into that, but they're taking that first step into our market because of our fundamentals. We've had incredible population growth, over 29,000 new jobs in 12 months. We've got lots of wage growth, 5.2% wage growth in the last 12 months. We've got really low rents compared to the major markets. And our wage growth is outpacing our rent growth. And so that makes us very affordable. And a national average for affordability rent to income is over 30%. We are 28.3%. So super affordable market. We're actually the second most affordable market in the major 50 metros in the nation.
Oh, wow.
And so all of that, we've got a very educated workforce, lots of great jobs, mostly in technology, the trades, manufacturing, healthcare, education. So all of those things are really bringing people here. And the Twin Cities has been the number one most sought after place for renters in the entire nation for the last 6 months.
Hmm.
And so we think of the Twin Cities as cold, oftentimes. We think of people not wanting to live here for cold, high taxes. There's a lot of reasons that Minnesota can have struggles in the investment world. However, we're definitely seeing a shift to people wanting to live here because it's a better lifestyle location.
Yeah, we did a recent offering, and probably the biggest hurdle that we had to get over with, and quite frankly, even the people that there was plenty of people that just didn't, they weren't going to get over it. That just the fact that we're in Minnesota and it's a blue state, and we've got rent control in St. Paul, and I think that really actually draws people's like, I don't like rent control in St. Paul. Well, wait a second. If you're buying in Blaine, that's not St. Paul, but people just still associate it with St. Paul. It just is. It just is what it is. And so there is a negative, there's definitely a negative vibe around it. But if you know the state, if you know what's going on here, you mentioned all the good things that are happening, even despite maybe some of the negative things. But as an owner myself in properties that are in red states as well, the Twin Cities doesn't have that. It's really not a disadvantage for tenant landlord laws. I mean, there's a few things that in Minneapolis and St. Paul, but for the most part, I can still evict a tenant fairly quickly if they don't pay rent. Um, it's just not that big of a challenge. Uh, our our bad debt in the Twin Cities is the best in our entire portfolio. When I look at the bad debt in the reddest state we have, Tennessee, it's the worst in our entire portfolio is the red state, where Minnesota's the best as far as bad debt goes. And one of the nicest things about it being a red or blue state is that there's a lot of help for these tenants when they do get behind on rent. So even though they haven't paid their rent and we do file the eviction, the vast majority of the time, some agency steps in and pays their past due rent, and we're caught up, and we don't have to actually finalize the eviction, right? So there's
Wow.
there's good and there's bad, but
Todd, I didn't expect to hear that from you.
I know I've been negative on the Twin Cities overall, but I still, it's still home, and
Yeah.
there's still positives here, and there definitely is, and there's always negatives with the positives, but I think overall the market is very sound, and that's why we like the Midwest. That's why we always continue to invest in the Midwest. Is it's slow, steady growth, and that's what you're going to get, and that's what we're seeing here.
Yeah. Hmm.
So, Heidi, any other stats or any other things you wanted to mention?
Yeah. So we had talked before about like a record number of properties on the market. People often ask me, why is that? And I've probably got three main reasons. Retirement is like our bread and butter, long-term private equity that it's gotten harder. The things you said, bad debt, it's not as bad in the Twin Cities, but it is a challenge and you have to chase people around to get paid sometimes. And so, it's gotten harder to manage residents, and residents have become more vocal. So it's gotten harder for a lot of mom and pop owners or
Yeah,
family offices or management companies. That's been a change, and it's been a rapid change, probably since COVID, really. Since
yeah,
COVID,
yeah.
things
Big
have
difference.
changed and they've gotten harder. So we're doing a lot of retirement sales where people are kind of just like, I'm out. Um, and then we've got debt obligations, of course, people who got these amazing low interest rate loans in 2020, but they were very short term. Those have been coming due. And when they came due, their rates were double. Now it's eased up for some people, but when your rate is due, your rate is due. You got to pay it. You got
Yeah,
to pay your loan.
yeah,
So debt obligations, people are being forced to sell. Developers, that Blaine deal, for example, developers that just want liquidity again because they've got shovels
mhm,
in the ground at other sites. They need some liquidity. They got to sell a couple assets because when they stop developing, they actually lose all of the people on their staff. So if you don't have anything to build, you got to keep your people working and you got to
yep,
keep them employed. The moment a developer loses their staff, that can take 2 years to
yeah.
just build staff again, and that train them, get them ready. So
When you
you're
lose reputation too, right? It's really hard to hire the same people back
yeah,
once or twice or three times. I mean, it's just challenging.
yeah. So I would say those are the three. You've got retirements,
Mm,
debt obligations, and then liquidity. And that is really driving this surge of properties. I think the surge is actually going to continue for a while. We do have a pretty typical quarterly 30 transactions a quarter kind of reputation in our market, which is not that much, not very many transactions. We're probably going to have, not in this quarter, maybe not even next quarter, but keep an eye on the Twin Cities for Q4, Q1 of 2025, and Q2 of 2025, because I think we're going to have 60, maybe in some cases more than that, properties trading. And so it'll just be a really interesting time. And then we're going to have a change as well. If the Fed cuts rates, then we're going to have all of our sale comps are going to be reduced pricing.
yep,
And then me as a broker, I'm going to be fighting buyers to say rates were different then. Now
yep.
pricing is is higher now because rates are higher.
Yeah, but
So
Heidi, I couldn't buy before when rates were so now I can pay that price.
yes.
Uh, um, yeah, I've been waiting for this retirement kind of phase to start kicking in, and so that's I, I I'm glad you said that because that's what I was wanting to hear, I guess, and what I've been waiting to hear is when I look at the vast majority of people that, especially in the Twin Cities, the Midwest is a market where people buy properties and they can hold them forever. And so that's kind of what I've been waiting to hear is, all right, people are retiring, they're selling their properties, they're moving on. And I agree, COVID probably sped that up because things changed very quickly in all markets. COVID made owning apartments more difficult. It just did. And tenants more vocal, and just everything about it a little bit more difficult. And then of course you've got inflation coupled upon on that. So insurance costs have skyrocketed, and property taxes are going up insanely. And so, NOI has struggled certainly. And if you're looking to retire, you're saying, hey, I'm just done. Like maybe I would have held on for a couple more years, but this is just enough, right? I'm ready to go. So yeah, it'll be interesting to see what unfolds. Exciting to hear that potentially over the next couple quarters, there's going to be a lot of inventory. We'll see what that does for pricing. I'm hopeful that it brings pricing down. I'm hopeful that you're wrong and we're not at the bottom, but of course you're hopeful that you're right and we're on our way back up. So we'll see what happens and unfolds there. But if you're a buyer in any market, now is a great time to be looking, because I generally would agree if we're not at the bottom, we're close. And it's a great time to be trying to buy properties because you're buying them for a 20 to 30% discount from the peak of the market. So your basis is just way better. And if interest rates continue to play in your favor, that only helps the situation. So
Mm-hmm.
great. Well, Heidi, I really appreciate you coming back on the show. Any last things you want to hit on?
Well, yeah, I think you touched on it. Buyers, now's the time to buy. It's still hard to buy, but I think it's hard to buy because the interest rates are hard and lenders are still kind of tight.
Yeah.
However, if you're looking, when people look back at the Great Recession and they're always like, oh, I should have bought now. This is that time that you're going to look back and you're going to say, oh, I should have bought then. So buy now. And then sellers, pricing is going up. So this is also a time, if you're ready to retire and you've held this property for 30 years, you can either keep watching it, keep hoping for interest rates to go down and then act then. Or, now is a time, we've got a lot of eager buyers out there and buyers are coming back and pricing is going up. So I think things are looking up for our market and then also markets across the nation.
Heidi, how can our listeners reach out to you and Michael Commercial?
Yeah, find me on LinkedIn, Heidi Addo, kind of simple last name, Addo, and DM me. And love to connect, love to get together, love to schedule video chats.
And Heidi's always got some good posts on LinkedIn, so definitely connect with her there, whether you're in the market or not. She's always got some good information out there, so appreciate it. Heidi, thank you very much, and you have a fantastic rest of the day.
Thanks, Todd. Appreciate it.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.